Welcome to Trade Pro. In this video, I have a simple strategy for you with a decently high win rate that can give you an edge in the market so you can finally be consistently profitable. This strategy uses very simple rules, just using two exponential moving averages to your advantage. All the rules are completely objective, so it's easy to follow. Anyone can do it. All you have to do is use consistent, good risk management, follow the strategy, and based on the testing results, you will come out profitable. So I'm going to go over the strategy, test it 100 times in a row, and show you all the testing results so you can see what to expect from the strategy based on the historical data. So let's get into the strategy just after a quick shout out for my affiliate, Capitalize.ai. Capitalize allows traders to create and automate their trading strategies just by typing them out in plain English, no coding knowledge required. You can simulate, backtest, and deploy strategies all from your phone, and all for free. Check out my link in the description down below if interested in trying it out. Thank you. Now let's cover the strategy, starting with the indicators that you'll need on your chart. So all you're going to need are two exponential moving averages, one in yellow here being the 50-period exponential moving average, and then the one in blue here being the 20-period exponential moving average. Mind you, I'm on the hourly time frame of Bitcoin against the US dollar. Now let's go over the different rules to take an entry using this strategy. The first step to this strategy is waiting for the 20-period exponential moving average to cross over the 50-period exponential moving average. If it crosses up over the 50-period, then you're going to be looking for a long trade. If the 20-period exponential moving average crosses below the 50, then you're going to be looking for a short trade. An entry signal with this strategy is given on the very first pullback into the 20-period EMA after the cross of the two EMAs. So for example, for a long trade, the 20-period exponential moving average crosses over the 50, and then price pulls back into the 20. Your entry price is that touch of the 20-period exponential moving average. For a short trade, we get the cross down, and then we wait for the first pullback into the 20-period exponential moving average. That's going to be the entry for a short position. Now that you have entry criteria, where's the take profit target? Well, it's going to be placed at the highest or lowest point before the pullback to the 20 exponential moving average. So for a long trade, you'll be placing the take profit target at the high before the pullback to the 20 EMA, and for a short trade, be placing it at the low before the pullback to the 20-period exponential moving average. The stop loss placement is very simple. It's just going to be using a 1-to-1 risk to reward ratio. So stop loss is based on where the profit target is placed. Now, I do want to remind you that this method of placing the profit target and the stop loss are not ideal. I have just chosen this for the 100 tests, and it does happen to work out quite well. But I'm sure if you tested different risk to reward ratios, different methods of placing the stop loss, different methods of taking profit, that you could increase the potential of this trading strategy. So don't think that using this 1-to-1 risk to reward ratio with using the high or low before the pullback as the profit target is the only way to do it. It's just the way that I'm going to be testing for this 100 test video. Okay, so make sure to experiment and find what works best. Try out all types of different risk reward ratios. Try out different methods of trailing the stop loss, using ATR for stop loss placement and profit target placement, and whatever other ways that you can figure out to test for the stop loss and take profit target to maximize the potential and results from this type of strategy. Very simple, gives you an edge in the market. But the way that I'm showing it isn't the absolute only way and the best way to go about it. Okay, so just wanted to be very clear about that. But anyway, that is the strategy. I'm just going to quickly go through a few more quick trade examples so it makes 100% sense to everyone. and then I'll get into the 100 tests and all the results at the end. All right, so I'm going to go over 4 different trading opportunities that we see in this range. And starting on the right-hand side here, we see the cross down of the 20 below the 50. Then we wait for the first pullback into the 20 right here, gives us our entry. Then we're going to be targeting the low before the pullback to the 20 and using a 1-to-1 risk to reward ratio, which does end up working in the trade's favor. So let's go back here where we see a cross up with the 20 over the 50, and then the first touch down to the 20 after that cross up. We'll be targeting the high before the pullback and then using a 1-to-1 risk to reward ratio. So you can see that one does work out. And then this one crosses to the downside, so we wait for the first pullback into the 20 and then target the lows before the pullback using a 1-to-1 risk to reward ratio, and that one is also successful. Then we see a cross up right here, so we wait for the first pullback into the 20, targeting the high before the pullback right here, and using a 1-to-1 risk to reward ratio. That one does happen to work out as well. Now let me just find a loss here. We'll just keep going back till we encounter a loss, just because I don't want to only show profitable trades. Here we have a cross down, so we get our first pullback right here. We target the lows and using a 1-to-1. Okay, this one's also a winner. Here's a loss, so we see a cross to the upside right here. And then we would be buying at the 20 and targeting the highs before the pullback. So this one ends up being a loss. So there we are. Those are some examples. Very, very simple strategy. Sometimes if you're in a strong downtrend like right here, you get these temporary crosses up that just don't quite work out. So this is where you're going to encounter some losses. If you take a buy signal right here, here's another loss, as you can see. And then just one more here. We get our cross down, and then we get the first pullback. Doesn't look like it touches here, but it does certainly touch right here. So there's our short position, and then targeting the lows with a 1-to-1. That one works out. Okay, so hopefully it makes sense, very clear now. Gone over a lot of examples and very simple rules. So I'll get into the 100 tests and cover all the results at the end so you can see how it performs. Now let's get into it. All right, the results are in after the 100 tested trades, and they're pretty good with a decently high win rate at 63%. This gives you an edge in the market based on this test, as all you really need to be a profitable and successful trader is something that puts the odds in your favor. And even with a 1-to-1 risk to reward ratio, this greatly puts the odds in your favor. So let's cover the results here. Starting at the top, the market tested on was Bitcoin against the US dollar on a 1-hour time frame using a 1-to-1 risk to reward ratio. It took 8 months of price data to get the 100 trades. There were 63 winners and 37 losses. The most wins in a row was 6 and the most losses in a row was 3. So relatively small drawdown at only 3 based on this test. The gain on the account figure, if risking 1% of your account equity per trade, 26%. So that would mean a 3% max drawdown if you risk 1% per trade. With something like this where it only has a maximum drawdown of 3 losses in a row based on this test, you can risk more than 1% of your account equity per trade. So that's why I've kind of listed the different risk levels. If you risk 5% of your account equity per trade, then your gain on the account is going to look more like 130% over that 8-month period. A lot of people do criticize strategies that take a long time for 100 trades, and they compare it to long-term holding. But that's not a fair comparison to make if you aren't including the maximum drawdown in that. So if we risk 5% of our account equity per trade and our max loss in a row is 3, then we're going to have a drawdown of 15%. But if you buy and hold Bitcoin long term, you're going to have a much, much larger drawdown than 15% on your account equity. So it's just not a fair comparison to make. And if you do want to make that comparison between trading and buying and holding something long term, you do need to equate that maximum drawdown and make it fair between the buying and holding and the trading. Okay. Not to mention, you don't actually know that when you buy and hold something, that it's going to continue producing those types of returns, especially with something like Bitcoin, where the law of diminishing returns comes into a play eventually. We're not always going to see Bitcoin giving these massive gains going 30 years, 40 years into the future. It's just not going to happen. So yes, Bitcoin's new and it had massive gains in the past, but will that continue? I don't think so, and especially not at the rate that it's been going at. So let's kind of actually do the math here. Let's say Bitcoin has an 80% max drawdown, or let's just say even a 50% maximum drawdown here. And so if we do 50 divided by 3, because we get 3 losses in a row, we can figure out how much we can risk per trade to make it a fair comparison. So we'll go 50 divided by 3. So we can risk 16.66% per trade. So we'll go 16.66, multiply it by our 1% risk gain on the account figure of 26%. So 433% gain on the account in those 8 months if you had risked 16.66% per trade, which would give you a maximum drawdown of 50% on your account equity, just like buying and holding would have. So it's just making that comparison. I'm just kind of leveling the playing field for a lot of people in the comments are, criticizing strategies that take a lot of time to get 100 trade signals. But the thing about it is you have to keep that in mind, the whole drawdown factor and how much you're risking per trade. Those things need to be accounted for before you make an argument. And also, the fact that you don't know what the long-term outlook is going to be when you are buying and holding something. You don't know what's going to happen. You don't know how long it's going to take to make you money, or if it even will ever make you money. So just, playing this side of the trader who, and someone who's been trading for quite some time and kind of doesn't see it so one-sided or so black and white, where people say, why not just buy and hold Tesla, or why not just buy and hold Bitcoin? Because you would have made this much if you bought it in 2010 and held it till now, So yeah, just not really a good comparison is all I'm trying to say to kind of end this little thing here. But we'll move on to the strategy ranking spreadsheet and kind of compare it to the other strategies that have been tested. All right, so here it is on the strategy ranking spreadsheet, falling at spot number 48 out of the now 79 strategies tested on the channel so far. So this one, not falling extremely highly on the ranking spreadsheet, but still, I think that it is a valuable strategy to have in your arsenal, as it can give you a very simple edge in the market. Using even a 1-to-1 risk to reward ratio, it still was profitable. And I do believe with some adjustment of that risk to reward ratio and the method of taking the profit and placing the stop loss, you can definitely improve the results of this strategy greatly. So for that reason, I would rank this strategy higher on the ranking spreadsheet. Kind of just looking at the gain on the account figure doesn't really give it a fair shot, but I could probably say that about quite a few of the strategies as well. But anyway, this one is promising and has a decent win rate. It will finally give you an edge in the market. But anyway, thank you guys for watching. I appreciate it. Hope everyone has a great day.